Welcome to the U.S. Asia Law Institute's last speaker event of the fall season. I'm Jose Alvarez. I'm the faculty director of U.S. Asia Law Institute, and we welcome all of you to this last one, but also remind you that we are going to go on a short break as the entire school shuts down, where the students take exams and the rest of us just grade them. But we will be back sometime in mid to late January, and there will be announcements of the particular events if you just look at future events on the website. So today we're very privileged to discuss, the title is Unleashing Mass Entrepreneurship, the Impact of China's Registered Capital Reform. I'm not going to try to summarize the paper that I believe is it attached to the it's on SSRN, so you can actually look at our distinguished discussant, Wei Cui, who is a visiting professor here at NYU and teaching this semester. And he is a professor at the University of British Columbia since 2013. His research encompasses a wide range of topics, especially in tax law and policy, including international taxation, tax administration and compliance, value-added tax, and spending policies targeted at the labor market. His most recent book, The Administrative Foundations of the Chinese Fiscal State, published by Cambridge University Press in 2022, offers a systematic study, I believe the only one in English that I know of, certainly, of Chinese taxation system, and explains the lessons of China's successful revenue-raising effort, especially for many countries, including perhaps the US, that had considerable more difficulties in collecting tax than others. This paper is a work in progress, as I understand. So we are very, very happy to have a discussant who will either poke holes or praise whatever the paper indicates. And our distinguished discussant is Robert J. Jackson, the Pierpoint Family Professor of Law, who is the co-founder of the Institute for Corporate Governance and Finance, and also the director of the program on corporate law and policy here at NYU. He has been a very significant participant on insider trading, including legislation to attempt to control it and to close gaps in the existing law. He served as commissioner of the U.S. Securities and Exchange Commission from 2017 to 2020. And before that, he was at a school we generally do not name, but it's uptown, and previously served before that as senior policy advisor at the U.S. Treasury during the financial crisis, and a deputy to Kenneth Feinberg while he was doing his work as a special master on executive compensation.
Thank you so much. First to Jose, to Catherine, to other colleagues at Izali for organizing this event. And thank you all for coming. And special thanks to Rob for commenting on the paper. And so I'm very excited to be doing this. This is a highlight for the semester. So I'll be presenting a working paper with Professor Mengying Wei from the University of International Business and Economics in Beijing. This is work in progress, so I will try to talk to no more than half an hour. We're very happy to get comments. This paper will go through rounds of revision before submission, and so any comments you can provide, we much appreciated. This paper aims to address, is formulated to address a broad literature in law and finance and development and economics. So our ambition, our goal is to make it of interest to scholars who are not even interested in China. But today, I'm very happy to have a path of lesser resistance, talking to people who already have some interest in China. So let me motivate this project for an audience, for the Valley audience. So for the persistent theme in international commentary on China's economic policy for more than a decade has been that the state sector has an advantage, the private sector is vulnerable, faces business uncertainties, or even is in retreat. This idea has resonated, especially 2 years ago when the crackdown on tech giants began, and also when the government withdrew support from big real estate developers last year. So in some quarters, this idea that the private sector is in retreat is taken as conventional wisdom. For others, there's a sense of dissonance because we seem to be seeing an endless stream of highly productive, innovative private companies from China. And these include both listed companies and private companies. So the Economist had a report this August called Meet China's New Tycoons, which captures this paradox. It's a delightful read. It lists a number of companies that many of us outside China have not heard of. I want to say after reading this article, I felt very curious, but I also want to say that this matters not only for Chinese people's lives, they arguably also matter for our lives in North America. And so one example I would give is that this year, the most important policy development in the US is the passage of the Inflation Reduction Act and its climate provisions. And the most important premise of this policy, this most important policy legislation in the US is that renewable energy, especially solar energy, is now so cheap to generate that the most important urgent thing to do for the US is to promote the adoption of this cheap technology among businesses and among consumers. But if we ask the question, how did the renewable energy become so cheap? Suddenly, this is the most important thing to our lives. Scholars have actually done research on this question, and it seems that has something to do with private companies in China during the last 20 years. So I think the paradox of China's private sector, whether it's in retreat or whether it's actually a fertile ground for entrepreneurship of significance to the rest of us in the world, is an interesting paradox. I became interested in this sort of debate. You can say, it's a public debate, partly also because I study Chinese taxation, and I noticed a number of very important policies adopted in the last decade that are pro-business, that are directed at a mass population of entrepreneurs, not just select few companies, are underreported in the West. And so examples are very large, very continuous tax cuts adopted that the media rarely covers. There was an impressive business registration reform carried out in 2015 across the country. There is a policy agenda called mass entrepreneurship and mass innovation that has been in place in 2014. And so you see officials promoting this campaign every year. And some of you may have heard the World Bank has a doing business ranking, and China rose very rapidly from 2013 in the 96th place to the 31st place in 2019. Okay. So it's possible that all this is government propaganda. We can discuss this. At the same time, I think there's something that we need to be aware of, which is, I will call it an incumbent fallacy. So if we talk to our friend in China and ask them how they're doing, and they say, not as good as before, maybe that's because our friends are the people who were successful in the past, and we're not realizing everything is downhill for them, but we're not seeing the massive amount of new entrants in the market. So that's the broad motivation. What we study in this paper is, I think, the most important piece of legal development in corporate law in the last decade. The company law was amended in 2013 solely to reform what's called the registered capital system. I will describe the registered capital system to you, but very briefly, it's an important system. It's deeply ingrained in the business lawyer's psyche until its abolition. It requires basically a minimum equity contribution by owners of a business upon business formation. And so at the in 2005, this barrier was lowered to 30,000 RMB for limited liability companies. It could be as high as 100,000 RMB for companies, LLCs owned by a single shareholder, and it could be higher for select industries. Not only do you have to make this contribution at the beginning of the company, you have to keep that capital there. So a reduction of capital below declared registered capital is supposed to be very cumbersome. Okay, and so this system was in place in China. The US has abolished this kind of law a long time, maybe half a century ago. And Europe abandoned the system. Europe had a debate about whether to keep registered capital up until the 1990s, and then it was abolished except for publicly listed companies. So basically, if we talk to US legal scholars who have a lot of influence on Chinese legal scholarship, this system would simply be dismissed. But at the same time, we need to keep in mind that what works in the US may not work in China. We want to evaluate how this system functioned and what happened when the system was abolished. So this is what we do. To give you a preview of our study, this is an empirical paper. We think we have a highly unique, very valuable data set. It's a confidential taxpayer data set comprising all firms from a very large province, and it covers 7 years from 2010 to 2016. So it allows us to do analysis otherwise not available. I will show you some of this results we find. We use this to study the impact of the 2013 company law amendment. Here are some simple preliminary results. We use something called regression discontinuity research design, and I will explain that. We causally identify the following policy impacts. That is, we're able to say with high confidence that the adoption and implementation of the company law directly led to some of these consequences I described below. First, we observe a very large decline in average total assets among firms. Okay, and this is an indication, I will explain, indication of several things. It means probably smaller companies entered that would not have entered before because of the minimum capital requirement. It also means that a lot of companies that would have entered the market before contributed less assets. That means that they over contributed before. They had excessive contributions for companies. We saw a more dramatic decline in paid-in capital, and so the equity amount in firms really dropped precipitously. Okay, so there's a clear impact of the reform. Strikingly, there's no change in average revenue and other non-asset measures of business operation scale. And so businesses that entered on average are not smaller by the scale of their operation. Okay, it's just that they contributed less assets, but they were able to serve the same or generate the same revenue, incur roughly the same expenses. Okay. There's no change in average profitability or loss-making likelihood. That means that we did not, the reform did not allow in a whole bunch of companies that shouldn't be there in the first place. They're as good as companies that had entered before that were able to meet the registered capital requirement. And in fact, we see an increase in profitability among the smallest firms. That could be interpreted as entrepreneurs who were very productive, that would have been good to have in the market, but they didn't have the cash to enter. And so that's we interpret this as evidence for that. There's significant increase in average debt liabilities, and there's some evidence for increased external borrowing in the largest firms. What this means is that firms probably would have preferred to borrow money instead of putting equity capital in. They were precluded from doing so. Now they are able to choose their preferred method of financing. Okay. Some additional results are obtained using different methodologies. Again, we're aiming causal identification. We want to say exactly this policy change caused certain things to happen. And so using what's called a difference in difference methodology and then a difference in discontinuities design, we find substantially increased entry of firms, especially firms owned by single individuals. But there's no significant change among unincorporated entity forms, for example, partners of individually owned enterprises. And so basically, we can say, given this bunch of results, the company law achieved what its proponents aim to achieve. I'll tell you a little more later about who its proponents are, because there weren't many. Okay. So overall, it seems that there was a dramatic increase in capital efficiency. There was no longer overinvestment of assets. There was reduced distortion in firm financing choices. There was greater entry by a wealth-constrained firm, including some high productive firms. So this should have been it seems to have been a very positive effect. Okay. So we like to think, but we want to make sure we think that this reform was highly meaningful. But there are two assumptions, and I'm happy later on to talk about whether these assumptions hold elsewhere, whether this finding can be generalized. And so the two assumptions are private entrepreneurs still have limited access in China. And so that's the condition under which this registered capital requirement would have been an obstacle. If that weren't true, this reform would be less meaningful. Moreover, we think this is a good thing because it's possible that in China, small business entrants bring higher productivity. And so this may no longer be true in the US. It's possible that in a highly developed economy like the US, all of the innovations are coming from large companies that are the incumbents. And this marginal entrants, the self-employed people, are not introducing much productive growth. So that's being debated. It's an important economic question. We don't know whether that's true in China. And so if it's not true, this kind of reform is highly needed. Okay, so my collaborator is an economist. This is what we focus on. We hardly do any kind of pitching in the paper about law, but for legal studies, this is the only empirical study of the effect of Chinese corporate law that I've seen, and especially on non-listed companies. Okay. So whether the registered capital system should be restored is actually still debated by scholars in China. And so I can tell you a little more about the Chinese literature, but we shift the empirical burden of proof. So this debate has gone entirely without empirical evidence so far. And finally, we're trying to think about ways this connect to a broad law and development literature. And so the basic idea is business entry regulation is a big barrier to economic growth in a lot of developing countries. This is why the World Bank published this doing business index. And so that literature is directly relevant to our study. Okay, so I am going to provide some of the background and then tell you about our study, our main findings, and then we will conclude. So here I have a table that gives you the legal details of the registered capital system and what the legislative change in 2013 did. So both under the prior company law regime from 2005 and the 2013 company law, a shareholder is liable to the company to the extent of subscribed capital contribution. Okay. And so under the prior regime, this principle was implemented through the registered capital system. What is registered capital? Registered capital, the registered capital of a company is the total amount of shareholders' subscribed capital that is reported to the Business Registration Authority and stated in the company's business license. And so this is officially evidenced, declared to the public. And the prior regime provided that for a company to be properly established, shareholders must contribute a minimum amount of equity capital, and such contributions must be verified by third parties. And so the minimum initial capital contribution was the greater of 30,000 or 20% of the declared registered capital of the company. And for single individual owned limited liability companies with 100,000. Okay. Whatever registered capital you declare, you need to fully contribute that within 2 years. And so there's a time limitation. At the beginning, you need to contribute a minimum, and then whatever you declare has to be fully contributed. There were limitations on the types of capital contribution. Cash contribution must be at least 30% of registered capital. All contributions have to be qualified by verified by qualified third parties. And so this is the red tape aspect as well. A business license must state the company as actual contributed capital. The shareholder registry filed with public authorities must contain contributed capital for each shareholder. And then there's a series of limitations on capital reductions. Registered capital cannot be reduced below statutory minimum. And if you want to vary it even above the minimum, you need to be going through a procedure of notifying creditors and so on. Okay. So basically, all of this was abolished in 2013. Here's a brief view of the legislative history. This change was not much anticipated. I can tell you that Chinese corporate law scholars, even though many of them, especially the American trained, were not too enthusiastic about this requirement. There were others, European trained especially, who were had scholarship that was focused on this requirement. But the government decided to change this. There was a vague mention of a State Council report to the National People's Congress in March. There was a State Council meeting in October 25th, 2013, but the content of this meeting was not released until after Chinese New Year in 2014. On December 23rd, 2013, draft legislation was presented to the National People's Congress, and 5 days later, it was adopted. And it was swiftly implemented 2 months later, after the Chinese New Year holidays across the country. Okay. So why is this interesting? One aspect, the legislative process, it shows you how fast this decision was made and quickly carried out. For our empirical study, this is important because I'm going to show you, we're going to be focusing on causal identification by saying that there's a date, March 1st, 2014. That's an arbitrary date. And so companies formed before and companies formed after should be roughly the same, except for this policy change. That very much depends on things being the same before March 1st. But if companies anticipated the implementation of this policy after its announcement, especially after legislation in December, our causal identification would be vaguer. We can still make claims, it would not be as compelling. Okay. So what we do in the paper is to check whether there was anticipation, and surprisingly, there was very little. And it's possible because the government chose a really good time that there was going to be New Year's holidays, and people did not pay attention to this. There was going to be a law in business formation. Anyway, but we're still surprised by this findings. So our paper tries to achieve what's called causal identification, but because the data is very good. But even without very complicated econometrics, I can show you some patterns, descriptive patterns that already are very revealing. And so on this chart, I show two panels, two figures. The first one is about average registered capital declared by firms formed along these dates. And so these are weekly frequencies. And you see that after March 1st, 2014, the second red line, declared registered capital immediately rose by a lot. Okay. And this is not surprising. You can declare a lot of registered capital without actually making a capital contribution now. And so that's an incentive to declare a lot. On the other hand, if you look at the right side, this is the proportion of businesses among all registered businesses that have very low registered capital. So before, you cannot have registered capital less than 100,000 for a single owner company, or less than 30,000 for other companies. Now you can do that. There's no requirement about what's the minimum. So this is the proportion of firms that declared registered capital of less than 30,000, and also clearly rose right after the date. So this next pair of graphs is more complicated, but it's very interesting from a legal scholar's perspective. And so let's look at something on the left side. So companies were required to contribute at least 20% of their registered capital. So we measure paid-in capital, which is the amount of capital contributed, and the ratio of that to registered capital. If you're below 0.2, you're in violation of the law. Okay. And so true enough, you look before, there were such companies, but the proportion is very low. And then it rose immediately, very quickly to a high percentage after the reform. The same is true for this ratio between 20% and 100%, because you're required to have fully contributed your registered capital within 2 years. So there shouldn't be that many firms. And you can see that these firms were very in minority. That did not rise very rapidly. And then the most striking one is this dotted line on the top. This is the proportion of companies that contributed exactly the same amount of paid-in capital as their declared registered capital. So if you think about it, this is an irrational thing to do, because the rational thing to do is to contribute the minimum amount required of registered capital, and then do whatever you want with your capital operations, right? That way you're not, really hindered by this system. And so this is what I would have recommended. This is what I did recommend practicing in Beijing. But I found out that my colleagues didn't want to do that. So people were really into using registered capital to signal to the public how much capital they actually put in, even though that seems to come at an important cost, okay? And in this study, we show that, in fact, it must have been costly. Otherwise, people wouldn't have changed this behavior. And then on the right side, we do this ratio, we plot it against firm size. And so the horizontal axis is firm revenue. We see larger firms tend to sort of adhere to this norm of having a ratio of 100%. Now the top is before the reform, and the bottom is after the reform. So you can clearly see newly formed companies have much lower paid-in capital registered capital ratio. So registered capital arguably is an artificial thing to put. Okay, that's the premise of some of this study. Let me show you something about the real operation. So this is actually what matters to economists. Let's look at the distribution of firms in terms of their asset size and their revenue size. On the left panel, the solid line is firms that were registered before the reform. And on the right side is firm registered after. You can see that the distribution clearly, the solid line is the after post-reform firms. The dotted line is pre-reform. You can see the distribution clearly shifted to the left. And so the firm, on average, firms, not only on average, but the entire distribution shifted to the left. Firms became smaller. But if you look at the revenue distribution, the change is much smaller. And so we did not see an influx of firms whose real business size is much smaller. And then one last descriptive graph. So this is the raw data about daily entry of business firms. So what you see is at the beginning of 2014, there was a period before Chinese New Year's, firms were forming. And so we have two series. One on the left is limited liability companies, and on the right hand, basically unincorporated business forms, including partnerships, and one form of company that's unincorporated. And so we see that this trend after during the New Year holidays, there's a lull. This registration rate picked up, and then it seems from this graph for limited liability companies, which are affected by the policy change, registration increased, but not by too much. In particular, we don't see a big spike here relative to the pre-reform average. So I didn't know you can do that to the screen, but one way to think about how firms waited for the policy to take effect at register is that you would see a big spike over here and then dropping down. That would be some evidence of firms delaying their registration, but we don't see that. So I'm going to get to basically the last part of the presentation now, which is I'll tell you how we causally identify the impact of the policy. Regression discontinuity basically means that choose an arbitrary date, and firms formed before that date and after that date should be arbitrary because it should be the same because that date is arbitrary. So what we choose here is March 1st, 2013, which in the absence of the policy, it would have been as arbitrary a date as March 1st, 2014. And we see that firms over time, if you look at assets, basically the longer a firm has been in existence, it will have more assets in its on its balance sheet. And so true enough, you see to the left, which are the older firms registered earlier, have higher asset And so you see, downward slope. The point is that at that date, March 1st, there should not be a discontinuity. It's a continuous trend. We see that, we find that for what we call the placebo date, when nothing happened. We see the same for total liability. So as firms operate more, they're able to borrow more or they incur more debt. So that's what you see. Paid-in capital firms gradually contribute more capital. You see a downward sloping trend. Same with revenue. Firms ramp up their operations, so the earlier established firms have higher revenue. But the key is in none of these do you see a discontinuity on March 1st. This is what happened on March 1st, 2014. So we see the same trend, downward sloping trends, except that there are huge discontinuities on March 1st. Okay, so this is what econometrically allows us to say that we think nothing else happened on March 1st, 2014. Only this policy change happened. And that's what caused this discontinuity. With this, we can estimate very precisely how much change did this policy bring about. So just very quick, data is very good. And so we're able to look at the details. If we look closely at these firms' balance sheets, we can identify exactly what was changing. Now, if you look at these variables, fixed assets, the company's plants, equipment, if you look at accounts receivable, what customers owe them, their inventory, what they keep in stock, really there actually was no change. Okay, and so these are the variables where there's no statistically significant coefficient. These coefficients are highly significant. And these are category liquid assets and in particular cash. And so we can say pretty exactly what happened was that firm put a lot less cash to the companies. On the liability side, accounts payable is one liability item we observe. That's what you owe to your suppliers, for example. And we see no significant change. That's, again, possibly evidence to indicate that the firms have the same scale of operation. But in terms of short-term liability, it shot up on average. Okay, and so firms started borrowing. A couple more results. This is where we confirm that in terms of the type of firms that entered, in terms of their business scale, their profitability, their productivity, you can say, there was no discontinuity on this date. Okay, and so the reform did not open the floodgate to a lot of bad, low-quality firms. We're able to confirm these results across the firm distribution. So these are tests about the same results that I showed you before across firm decile. So we divide firms into 10 batches in terms of how big they are in terms of revenue. And you see for all firms, except for 2 deciles in the top half, firms had lower assets. For paid-in capital, everyone had less paid-in capital. And for liability, most decile had increased liability. They borrowed instead of using paid-in capital. And then in terms of profitability, the most significant increase is in the third decile. So that's where some firms managed to make more than before. Okay. So this table presents the same results for the top quartile and lowest quartile of firms. The same results as before. Let me quickly show you for impact on firm entry. And so there so far we've talked about average across all firms, new firms. Here, let's look at what economists call the extensive margin, how many firms entered. Here we use what's called the difference in difference design, which is to say we're going to pick a group of firms that were not treated by this policy. And what we chose was limited liability companies that were state-owned or foreign-owned. And so many of you will know that state-owned enterprises have no trouble meeting some of these capital requirements. And in order to be a foreign-owned enterprise in China, you have to overcome a lot of hurdles. It's unlikely that this registered capital really matter to you. So we chose those groups as firms that are not treated by the policy. Compared to that, we want to look at what happens to all of the private firms, LLCs, that are treated. So on the left side, you will see that firm entry after this date generally went up. And on average, the effect of additional entry is statistically significant. The magnitude here is 0.5. So the average here is about 40% additional firms. That's a lot of new firms, right? And in fact, we're worried that our magnitude is a little too large. Okay. Just to probe this more, on the right-hand side, we show what happened to unincorporated business firms, how they formed. And what we found is that there was virtually no change across the policy date, as you would expect. We do further tests in the paper. There's a lot more to be done. I'm happy to talk about them if you have questions. To conclude, the 2013 company law amendment had a significant liberalizing impact. Its aggregate implications. So we're just showing what's happening at the firm level. How did this matter overall to the Chinese economy? This deserves closer studies. I can tell you that there is a paper that other highly competent economists are pursuing, a version of this that was carried out in Guangdong in 2013 that confirmed that a lot of firms entered, competition increased in the Guangdong market, and firms seem to have become more productive because of the competition effect. Okay. This is also important for law. Also, firms, the government wanted to have this requirement because they want to protect creditors. Does that mean that we have more deductive bankruptcies afterwards? I don't know that it has been studied. I think we should use the China law database maybe to examine whether this has happened. It's also important to think about the generalizability of this to other developing emerging economies. So it's likely that this is not going to matter for the US. Any kind of analogy to the US would be some kind of requirements that's hurting financially constrained small firms. Maybe there aren't that many, but there's definitely no direct analogy. But we know that business entry regulations is not unique to China. And this kind of regulatory requirements is probably not unique to China. Thank you. That's my, thank you for listening.
Thank you. So Rob, your turn.
Well, first of all, thank you so much, Wei, for the chance to comment on this paper, and to say, and to the Institute for the chance to be here today. I see that we have maybe another 20 minutes, so I'm going to limit my comments. I want to have a conversation with the audience. First, let me start by saying this is a wonderful empirical intervention with relevance to macroeconomic questions, U.S. corporate law questions. I've been teaching the subject of capital constraints in U.S. corporate law for a decade and learned a great deal from this new evidence. So I think this is a very exciting empirical intervention. I'm going to offer three comments on the paper in part ways that are, can I use your slides to show the audience what I have in mind? Because I thought they were so helpful.
Yeah.
As I flip back, I'll give you a sense for where my three comments will focus. First, I want to talk about the way the paper is framed. What you heard from Wei was a paper about liberalizing capital constraints and the increase in firm activity and entry that followed from that process. I want to talk a little bit about whether that's the right way to think about the only way to think about what we found here. My own view, as I'll say more about in a moment, is that framing interacts importantly with other sources of capital and the particular context in China about the degree to which other sources of capital are or are not available. And so something we don't hear a lot about in the paper that I think we should hear more about in the future is about the Chinese banking system and the degree to which it does or does not provide capital to enterprises of this size, and what that tells us in the unique context that we're studying about the importance of capital constraints. More on that in a moment. First. Second, in the theoretical setup of the paper, you'll see that there are some strong assumptions about the degree to which small Chinese firms are capital constrained. And I want to talk with Wei about whether those constraints are necessary as a way to think about the implications of his evidence. And if we relax those assumptions and think that there are other places where these businesses might find capital, would we think this change the law as important as Wei suggests that it is? And that might go a little bit to what Wei said about the size of the effect that he observes being surprising, because I share the view that this is a very, very large effect, larger than I would have as a prior. And then finally, I want to talk a little bit about the empirical design, because in particular, the difference in difference design requires, as all DID designs do, parallel pre-treatment trends, and I'm not sure that we have that. And I think there's actually some evidence that there was some anticipation of the reform. And at the highest level, before I go into those details, let me just say that my one message from the one thing to take away from the next 10 minutes of your life is that Wei, in addition to writing this peer review paper, which is obsessed with causal identification, Wei must also write a law paper that explains the role of registered capital rules in the development of the Chinese economy, the role of Chinese banks in providing or not providing capital to firms of this size, and tell us a little bit about the development of this law, why it was so important from a legal point of view. Because I can tell you, as someone who's written both peer-reviewed papers which is what this is, suited for a very advanced economics or finance audience, and law papers, Wei does not have the luxury in this kind of a paper to give all the detail about institutional design that I want. So don't worry, just write another one. And plus you get 2 papers out of 1 data set. So I'm all about economies of scale. So just at a high level, let me say what's great about the paper. I'll give you my 3 comments. What's great about the paper is, first of all, the data are extraordinary. And I've been teaching capital requirements in the United States for a long time. The idea that you would have this kind of taxpayer level firm formation data in an experimental design is unheard of. Forget about a study of China, a study of anywhere. I would be happy to have it in a study of New York. It's an extraordinarily extensive data set, not just in terms of the time series it covers, but the depth that we get for each individual taxpayer in the firm's formation. So this is an extraordinary contribution in my view. Also, we have a nice setting, because what happens here is, after many years of having a registered capital requirement, more on that in a moment, the Chinese government comes to the conclusion that it doesn't make sense in the stage of the economy's development and decides quickly to repeal it. And they move fast, as Wei points out, which is nice for a causal setting. One reason in the US you can almost never do a study of a legislative change is that it takes forever. Everybody knows that it's coming, and so the claim that it is causally identified is weak. Here, not so, for the reasons that Wei explained in his setup of the legal change. So that's what's great about the paper. And also, let me just say, it contributes not just to the literature Wei told you about, but one that he didn't, one that's a little more familiar to me. I teach corporate law and economics, and it is a fundamental precept. I mean, it goes all the way back to Easterbrook and Fischel in the early 1980s of the law that I teach and study, that capital requirements of the kind Wei is evaluating here almost certainly have negative effects on Calder-Hicks efficiency in firm formation for the following reason. You can imagine a situation where we require firms to hold a certain amount of capital on their balance sheet. In your mind, just think of it as cash. We require the firms to hold that capital so as to protect creditors, so that lenders to the firm have some place to go if the firm is insolvent. But if we impose one rule for all firms under all circumstances, which is what China did before 2013, we probably get it wrong in terms of the optimal amount of capital that creditor would require for protection. No, the way I teach this is that we should allow the creditors to negotiate with the firm to say, we'll lend you money, but we can have a negotiation over how much you have to hold in the box for us to be confident that in insolvency we'll have recourse, and then we'll negotiate the interest rate on our lending accordingly. As a result, the United States has never been favorable to these kinds of capital requirements. We actually didn't abolish it. We just made it irrelevant because in a corporation, the par value of a share, as a matter of Delaware law, is in theory supposed to be held in stated capital. But in practice, this can be contracted around. And that's why, by the way, just as a footnote, if you've ever seen a stock issuance in the US and you see right on the cover page, it says par value. Even a company with very, very high share prices will have almost no par value for its stock because the par value is required to be held in the firm. And their lawyers are clever and want to give them lots of flexibility. So when Google went public, its par value was 1/100th of one share, even though those shares trade for many hundreds of dollars each. So we contracted around this long ago. Europe is more favorable to it. And as Wei says, China was too until recently. I want to say in the US, it's not unheard of to have a capital requirement. Can you all think of any firms in the US that actually do have capital requirements? There's one type that should come to mind. Banks. We require banks, as a matter of public policy, to hold a certain amount of capital in the United States. Why? Because their creditors need special protection. Their creditors are depositors. And so we provide them with some, and we acknowledge that these capital requirements have efficiency costs for the bank's ability to put the capital to work. The fundamental idea of Wei's study fits right into this literature, right? Because China has this requirement. They see that it's got efficiency costs. They make a change, and all of a sudden you see lots of firms enter. So in that way, with lower amounts of capital, I should say. So in that way, the study is very satisfying and tells me a lot about my intuition as to why these changes would be productive. But as I say, there are three things that I hope Wei will focus on as the draft evolves, or even in a separate law paper. The first is the story I just told, the story where firms, lenders get comfort when lending to firms because of the amount of capital held in the firm. To believe that it would make this much difference, I have to believe that other sources of capital for those firms were not so available. That is, I have to believe that I can't immediately turn to a bank to get the capital that I need to finance the firm. So just to give you a concrete example, I'm an entrepreneur in China. I want to start a firm. I don't have enough registered capital, but I can't find a bank or a partner who can contribute the necessary capital and keep it there while I come idea. That has to be the story we're telling. Now, it strikes me as very plausible that that would be true in this case. Why? Because these are very small firms, and the Chinese banking system might not be fully equipped to deliver credit to many, many millions of firms in this way. But this is why I would be keen to better understand the other sources of capital available in the setting. To give you an example about why I care about that, suppose I were to rewind what I just said over the last few minutes and say, let's do this experiment in the US. Let's suddenly reimpose capital requirements for firms in the US. Would you expect in the US firm entry to formation or efficiency to increase, to change significantly? I would not, because there's other sources of capital readily available in the United States, at least compared to the Chinese setting. So to understand this a little better, I think I need to understand the Chinese banking system. And here, I would love to have more detail in the paper itself. I also want to note something for you. One more thing about, by the way, why this paper is so important. One of the most obnoxious things about US corporate lawyers, and by the way, I don't have enough time to list them all, but one of the most obnoxious things is we take as for granted the wisdom of the conclusions we've come to. So we, for example, would say a registered capital requirement in firms, who would do that? And the answer is everybody else. So throughout Europe, for example, these have been very, very prominent for many, many years. European trained lawyers in China, Wei tells me, often take the view that these are beneficial requirements. But I just want to say the crucial nature of this contribution is highlighted by the fact that even though American lawyers and legal scholars have dismissed the need for a capital requirement, not everybody has. And what Wei and his co-author have achieved is pushing back, as they say, the burden of proof onto those who would favor such things to help us understand why we would suffer the costs that they impose in exchange for those benefits. So let me say a little bit about why I think the framing is not quite right, or rather a different framing might be helpful. One of the puzzles of the paper is that, as I said earlier, I need to know where the other capital would come from for these firms in order to understand how binding the constraint Wei is studying is. And we, in fact, do see an increase in borrowing in the firms he studies. So it's not a complete story to say that, well, there's just no banking the Chinese banking system is not able to reach these firms. Instead, what I think is it's a story that the banking system reaches some, but not all of the firms. And then I think we can tell a more layered story about which firms it reaches, because Wei, I noticed in your slides, I was taking a look at them last night, and you provide us, this is one of the great things about the richness of the data set, you provide us with a decile by firm size change in liabilities. And these are firms are getting larger here, right?
These are, yes, exactly.
Firms are getting larger here.
Yeah.
So notice that the increase in liabilities, and this is something I kind of wanted to ask you about today, maybe you can answer in the Q&A. Sorry. Oh, sorry.
Yeah.
Here. So it looks to me like the increase in liabilities is occurring in smaller firms. Am I right?
Yeah, so this is a complicated calculation. We look at how much paid-in capital dropped. And so large firms had a lot of paid-in capital and smaller firms had less paid-in capital. We see how much paid-in capital dropped and how much liability increased. It turns out that it's the larger firms that had a greater magnitude of liability increase. And so this is the same magnitude, but relative to a baseline. And so these firms were borrowing a lot less, but they had the same percentage increase. And
So larger firms or the small firms?
So the smaller firms were borrowing far less.
Less and borrowed more.
And so even though roughly the coefficients are the same, they're not borrowing much more. Whereas for the large firms, because they started with a large base, their liability increase was actually bigger in absolute. And in absolute terms, it was a greater excess over paid-in capital, a greater excess over the asset drop. And so we think that basically the larger firms are probably going to external borrowing. And for the smaller firms, my intuition is that they are just doing shareholder loans. So they're not getting better access, but they decided that they can just shareholder loans, informal shareholder loans.
Yeah.
So that's one possibility, but we're still trying to investigate that.
I think that would be helpful in part because, as Wei shared with you, one of the possible implications of changing this approach is that creditors have less protection, right? Because and so you might think that in these smaller firms, if they're external creditors, they might suffer losses. By the way, that's as a law and economics, I don't view that as a bad thing. I'm actually happy to make a trade where some creditors suffer losses if we get more economic productivity. I just think that would be a good thing to break down.
Okay.
And by the way, I noticed in your presentation, you talked about the difference. You had one comparison of accounts payable.
Yeah. So going back to that accounts payable.
Yeah. So there's no change in accounts payable and the regression just got continuity pre and post, but there is an increase in short-term liabilities.
Yeah.
I wonder if we break this down by firm size.
I see.
So here you're controlling for firm size,
Yeah,
because you're just trying to show causality, which is helpful. But I'd actually love to see descriptively in the cross section of firm size, how this would differ. Because you might show me something different, depending on. So it might be that there are shareholder loans. It may be that trade creditors at the smaller firms engage in more lending. It's kind of hard to say based on this evidence. So my general comment is that I'd want to know the reach of the other sources of capital in China for these firms. I'd want to know more institutional detail about banking, et cetera. As I said, I have a comment on the theoretical model that I'll put to one side for now in the interest of time. I do want to say, as an empirical matter, I want to note something for you and get Wei's thoughts, because as you.
So we need to advance. So we're going.
No, but I'm going to. I have in mind. Yeah, I want to go back to figure one.
Figure one. I see. Okay.
Yeah. So a key, whenever you're studying causal change, a causal claim like this, a key assumption you're making is that firms struggle to anticipate this. I mean, I want to know just and get Wei's thoughts. You can see between the time of announcement and effectiveness, the change is already occurring. Yeah. Now, I actually don't think this is a fatal problem. In fact, what you could say, this is better evidence of causality because it shows that firms are responding to the announcement of the legislative change. But that's not the test you run, for example, in the RD or the DID settings. What you're doing there is you're just saying March 1st, the effective date is the crucial date. What's your sense about why we see these changes?
Okay. So for this one, I'm actually not sure whether the frequency, whether we're simply, okay, so you said there's only one observation in between. And so this is a small increase. This is just a reform effect.
So you don't think there's a data point in here?
Right.
No,
right.
How about here?
Um,
Again, you think this is the first observation, the date, the actual?
I think
date
so.
of
Yeah,
observation?
this is the last pre-treatment period.
I see. Okay. It's hard to know exactly what the frequency
Yeah.
is. Let me just make one last methodological point, which is about the difference in difference approach.
Yeah.
So, right. So what this is a measure, just to be clear, of treatment effects, the difference between your treatment group and the control group that you use, state-owned enterprises and foreign invested firms. And in general, the story you're telling us here is that firms enter post-event, and it's a very pretty graph, but as an empiricist, one thing I look at and worry about is this. What's happening here? So right before the reform takes effect, the treatment effect falls, and in fact, looks like it's kind of negative as a difference between the treatment and control before time zero. So I'm not sure this is an ideal setting in which to do a difference in difference. But I want to say, just to be clear, I'm not sure I care, because I know that Wei and his co-author want very much to do a causally identified paper, and I understand why, but I'm much more interested in the broader questions around sources of capital for smaller Chinese firms, which is why I'm thinking that a reframing or a separate piece that studies that might also be useful. But overall, I want to be clear, this is an enormously important contribution. I myself will teach capital requirements in US firms differently because I read the paper. And so I'm grateful to Wei for the contribution.
Thank you.
Thank you.
What do you think is going on there?
It's hard to say. So we actually, when you do DID, sometimes you just don't get good parallel trends before, and then you simply drop it. You don't figure out what happened before. Here, we want to think about whether this is an anticipation effect, and so that dip is in December, but the legislation was passed on December 28th. It seems too late to affect business entry in December, and so we don't quite know what to make of that. But I do agree that any kind of failure of parallel trend will threaten the DID results, and we need to fix that. Fixing that meaning at this point, not changing the data, but trying to find a different methodology that tells us how much this absence of parallel trend before threatens our results.
And a good summary in the difference between a causally identified peer review paper and a descriptively interesting law paper is that in the causal ID paper, you need to fix that. In the law paper, I just want to understand it. I just want to, whatever happened, I think it's interesting and important. So I'm keen to understand it, regardless of whether or not it upsets some peer review or something. I took longer than I wanted to, but I'm happy to invite a question or two from colleagues before we wrap up.
Do we go on ever, or we just stop at 1:30?
Go on, because I imagine everybody has some questions.
Yeah, so let's just
I've got
arbitrarily
questions.
have another 10 minutes. How's that?
Great.
And I'll tee you off with one question that immediately comes up. I think Rob's intervention, I take it, is in part asking what other forms of capital, on the assumption that one of the things that you really want to know, which I take from your paper, is how transferable or what lessons to draw to other countries. And if China is unique in imposing these constraints, then we can't take as much, right? Is that part of what you're getting from? So this could be a unique China paper as opposed to something the World Bank can try to use. And I guess one question I had for you is, does the World Bank discourage these kinds of requirements? Does it actually include this as part of its recipe book? Don't do this, despite the fact that the Europeans might still favor it. I'm just curious what the bank thinks is good for development.
That's a really good question. So I need to do more research. My understanding of the doing business index is more about the number of days it takes. So
Oh, right.
that's actually not on the question there, but so does the bank have a attitude, like a position on registered capital requirements, which would put, some European companies at an unfavorable light? I don't know. Yeah, but it's worth looking into this. Yeah.
I just want to be clear, because you say you're right. Part of what I'm wondering about, of course, I come to this from the context of which I mentioned. But I must say that even if it's the case that the relatively underdeveloped local Chinese banking system is partly explanatory of this, that wouldn't make it a China-only phenomenon. There are many jurisdictions at their developmental stage where you would think that's true. And by the way, you'd want to transfer what we learned from Wei to those jurisdictions. We'd want to say this might be a liberalizing move that would free up a significant amount of capital for more productive use, especially in a situation where on the margin, capital is underavailable. Just one thought.
Others.
Thanks. I got just quick question, and I apologize in advance if I shift this too much into the China weeds. But I guess two questions. One is, it strikes me, and it probably doesn't take away from your findings at all, but it strikes me that there's pretty big difference in entrepreneurial culture in different places in China. And so I just wonder what you can tell us, or whether in the paper you could say a little more about where you're doing this. Because it would strike me that places with deep entrepreneurial culture and a long history of small firms, might be different than so I'm guessing you didn't do this in the Northeast, for example, right? But the second thing I kept wondering about is, and maybe I'm just wrong about this, but that my priors would have been that what companies report to the tax authorities might not be fully accurate. And so now maybe again, if you're looking at this over time, it doesn't matter. But I'm wondering whether you and your co-author have thought about ways you could actually verify what's being reported. I don't know what I don't know if you're able to see the actual taxpayer's name or if it's anonymized, but I'd love to hear your thoughts about how to, given that so much has been written suggesting that what companies say publicly, especially public companies, is simply not correct, it's false. Why do we think these data are better? Those are
great questions. So quickly, this is confidential data. That's why we don't disclose the province that comes from. But it's a large province, and so we think that it's important to narrow it down. Yeah. And the other question is fabulous because this is a vast population of very small firms. They don't really need balance sheets and income statements for most purposes if they don't have active banks. And so they're doing mainly to report to the tax authorities. Most of the data we use in this paper don't rely on tax returns. They're financial statements. And so you can say that the firms may be a little more laid back about what's on this. But not only do we not know whether they report accurately to tax authorities, because no one else needs this information, we don't know whether they're reliably produced. And so this is a basic question we have. If you look at small firms everywhere in the world, including the US, what incentives do they have to keep accurate books? Even in the US, for self-employed outside tax returns, the incentives could be very low. And so that raises questions about how accurate each individual return is. And here, I think you alluded to the idea that as social scientists, we simply go with what we have and think about whether there are problems that threaten the particular question we're studying, as opposed to, in the abstract, whether this is completely a accurate depiction of reality. Although, can I say that you can also, again, this is where my question goes to whether you can actually, you don't have to tell us whether you can see the firm names, because it's an area where I would think about, like, okay, can we just check some of this, right? I mean, if you actually know the firm, then you might be able to interview it. Maybe we'll talk about things like that. So it's all de-identified. We have this data because the government trusts us, and they're not disclosing anyone. So we could be looking for firms, like which are the listed firms. We decided not to do that, right? In the research.
Ben, I just want to make a footnote to your question, which is really very important, insightful. One of the reasons I'm most interested in the interaction of all this with the banking system is that one of the few incentives you can imagine for accurate balance sheets and financial reporting for small business would be that banks insist upon it. So you might endogenously get different accuracy in Wei's data set for those firms that are facing financial institutions and those firms that aren't.
Catherine.
Yeah. So just thinking back to my time as a lawyer in Beijing.
Yeah.
I remember that foreign companies strongly disliked the registered capital rule, as you indicated. And I don't have any empirical information, I'm not aware of any study having been done of this, but I do know of some cases in which investors decided to actually not register a company because of registered capital rule. So I'm wondering whether, just as another direction of research, whether there was any change in FDI that could be related to this reform. Maybe for larger foreign actors, this would be very minor matter for them, but for smaller, I'm thinking of a couple of smaller actors who just decided it was simply too strange and inefficient, and they were not willing to do that. I also kind of share Ben's skepticism about the reality of the paid-in capital, because my recollection again from that time was that a lot of firms, there were stratagems, shall I say, there were approaches to making putting the capital in, and then it wasn't really there. That there were dodges that were well known that were used, or so I was told at the time.
Yeah.
That this was an area of a great deal of fraudulent behavior. But my question is, your account of how this happened in 2013 is really interesting, and I'm wondering whether the suddenness, the fact that the National People's Congress Standing Committee didn't follow the usual procedure of reading these revisions 3 times and issuing it for public comment and so on, is that because there was such a this was so widely supported that there was no debate and everybody agreed this was a good thing to happen? Or was it because there was anticipation of it getting pushed back, and so that it was just sort of slid in quietly before anybody could object? And whether who was it a project of Premier Li Keqiang, or whether there was a particular person who was pushing this forward, that it happened in such an unusual way. That would be interesting to know more about, again, from the China Wong point of view.
Sure.
And finally, your very tantalizing suggestion at the opening that perhaps the current leadership is more pro-market than we give it credit for. I found that very interesting and would love to hear more about that.
Sure. Yeah. Thank you, Captain.
I'm gonna run to offside.
Because we're time constrained, let me answer this question about the legislative process. I found it interesting too. So December 2013 was 1 month after the 3rd plenary session of the 18th Congress, and then people made a big deal out of that, right? And so this was early in Xi Jinping's leadership, and that's where he announced that rule of law will be his policy. And so I think of that's a clue that this was actually very important to this, so it was not the state council's project, it was not the NPC's project, it was the central committee's project, it was the CCP's project. I have one other piece of evidence that suggests this is what happened. And so in 2019, so 6 years after the legislation, the Supreme People's Court was still debating, do we have a registered capital system at all, given that we have no way of enforcing anyone's subscribed capital obligations? How do we do this? And so there was a series of meetings, internal meetings in the commercial tribunal. And apparently Chinese corporate law scholars testified and said, this is bad, that this is something that, we got rid of the system too quickly. We are too lenient. We are getting into trouble with bankruptcy proceedings. That's their claim. I don't know if they have evidence to support, but the Supreme, in the minutes of the meeting, the judges on the tribunal said, your arguments seem very compelling, But this decision has been made by our superiors, that this is how it is going to be. And so these are reasons I have for thinking that this is simply a very high priority policy agenda.
To send a signal to the markets.
Yes.
Yeah.
That's right.
Interesting,
Yeah.
very interesting.
I think you sort of just answered it, but from the very beginning of your very interesting talk, I was waiting for the last slide where you mentioned bankruptcy.
Yeah.
Because obviously, as Americans, getting rid of registered capital, we assume there will be more efficient use of capital.
Yeah.
And you certainly give evidence that's persuasive when you compare the size to the revenue.
Yeah.
On the other hand, to some extent, there may be firms that over-rely
Yeah.
on some sort of borrowing and external financing.
Yeah.
And in your time series, it may be difficult. We have to wait for maybe a small recession of some sort.
Yeah.
But have you given any thought at all to how to follow up and try to examine the other side and see if some of the firms relieved of the requirements went too far the other way?
Yeah. Yes, I'm very quick at coming up with ideas, bad at executing them. One obvious idea is actually to use some kind of data, like the one that Ben has been studying, but with people actually interested in bankruptcy, pick out all of the commercial disputes, especially bankruptcy cases, and find some kind of variations. For example, Guangdong is the province that implemented this slightly earlier, and so whether you see a earlier rise of problematic bankruptcy cases in Guangdong. So that would be a way to study. And I think that's important because it's very unlikely that the Chinese scholars are studying that. And young researchers focusing on corporate law should be doing this. So I'm moonlighting because I'm doing tax, and this is a non-tax project. But that's one approach I thought of.
Very interesting.
Yeah.
Could you also just remind me, it may be completely irrelevant, at what time are we starting to see a decent sized venture capital market in China? In the 2010s at some point, right?
Venture capital probably started a little
'Cause
earlier.
we don't know what province you're in or who these.
Yeah.
I'm not even sure what.
Yeah.
I'm not sure of the size of the companies either.
Yeah. So the firms we're studying are truly small,
I see.
and they're probably not interesting to us. You know, they're not the people, the
Wouldn't
tech
be
companies. So they're probably not the companies that did the solar panels and so on. Yeah.
No, just possibly irrelevant, but just a small reminder, not only the banking system.
Yeah.
But if there are other external forms of finance,
Mhm.
that would probably be part of the story as well, to the extent they may exist.
Yeah.
Any comments, Rob, in response to any of the questions?
I think these are very insightful
Yeah.
comments and hopefully helpful in moving the project forward.
Yeah, absolutely. Yeah.
Well, we've gone over time, so thank you both.